Welcome to Taking Stock for the week ending the 8th of July, 2022. I'm Kien, Trinh, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Great to have you on board again, Jace.
It's good to be here again, Kien.
But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented today should not be relied upon as a guide for future performance. Not surprisingly, this week the RBA raised their rates by another 50 basis points, and that's taking the cash rate to 1.35%. Interestingly, though, the market enthusiasm for rate hikes have tempered over the last 2 weeks, with previous expectations for the cash rate to rise to as high as 4.4% in 2023. But the market has pared back its interest rate expectations to peak at around 3.5%, even though rate rises are expected to increase abruptly for the remainder of the year. Now, in fact, economic growth expectations are expected to slow down, and a few economists believe that the cash rate could peak at 2.6% in the first quarter of 2023.
Yeah, well said, Ken. I mean, in reality, it's very difficult to predict how things would pan out. But looking at some of the facts, we can gain a better understanding of what's in play. So for example, when we look at the interest rates, we know that they're going to increase, and this is likely to usher in a period of slower economic growth. As such, companies that are financially unhealthy are going to be more vulnerable to a default on their debt repayments. Only last month, a healthcare stock that treats sleep disorders called Oventus Medical went into administration due to negative cash flows even after it raised equity during the year. Now, business failures are part of the business cycle, but if investors want to protect their capital, then they should direct their investments towards financially healthy companies with strong profit margins and adequate cash flows so that they can ride out this challenging period.
Yes, Jason, speaking about challenging conditions, we also found out this week that resource stocks are not immune to an inflationary environment. Like we saw commodity prices such as oil, copper, iron ore, they all fell significantly on fears of a global recession, leading to less demand for these materials. Resource stocks, by their nature, are volatile, so it's important that you hold a well-diversified portfolio to help you mitigate this volatility.
So you can use Stock Doctor to monitor the earnings revisions across these stocks to help you determine whether the volatility could perhaps create an opportunity. Now, this is especially true across borderline and star income stocks such as BHP and Rio Tinto. Both of these companies are expected to pay gross dividend yields of around 16% in the upcoming year. You can view a snapshot of the 3-month earnings revisions under Golden Rule 3, or look at the trend in forecast earnings under Golden Rule 4. And remember, if you're trend sensitive, consider the use of the SD Max or SD30 TSR to help you enter or exit a stock.
Yeah, some great advice there, Jace. But on the topic of resources, some of our star stocks like copper producer Oz Minerals, it's experienced challenging operating conditions, citing rising input cost pressures from labor shortages and higher energy prices. And that coupled with disruptive weather events, Oz Minerals had to lower their production guidance by about 13%. And they also had to increase their cost guidance by 17%. And this led to a significant negative revisions to its forecast estimates. And the share price was under pressure as a result.
So from a technical perspective, trend-sensitive investors should remain out of the stock, given that it has triggered an exit on the SD30 TSR and also on the SD Max. Longer-term investors who view the share price weakness as a potential opportunity only if they're comfortable with the active risks around input costs. Also, Oz Minerals' share price tends to be highly correlated to copper pricing, which is a bellwether for economic growth. Another risk to be mindful of is that Oz Minerals' return on invested capital is forecast to fall by around 14% next year, and therefore it may not satisfy Stock Doctor's Golden Rule 2 when it reports in August.
Yes, Jason, speaking about active risks, a sector that has faced negative earnings revisions are those in the automobile segment due to bottlenecks in the supply chain, which has led to shortages of microprocessors and a significant decline in new vehicle sales. And that was down about 9.7% in June.
Yeah, this risk was highlighted by us in borderline and star income stock GED Holdings with its trading update on the 21st of June. Supply chain issues are unlikely to be resolved in the near term. Hence, we are a little bit wary of these stocks, including ARB Corp as well, as we head into reporting season. In fact, the stock is displaying a negative 6% earnings revision in estimates. However, we have retained ARB under coverage for long-term investors because we believe supply chain issues will eventually ease and the demand for four-wheel drive vehicles and accessories remains strong.
Also, Jace, this week, Star Growth Stock and Star Income Stock, Pinnacle Investment Management, they released a trading update which revealed better than expected second half performance fees. This should provide some conviction in a quality multi-asset funds management business and mitigate the negative earnings revisions, which has dropped by quite significantly by about 14% over the last 3 months. The company is expected to go ex-dividend at the end of August and is currently trading on an attractive gross dividend yield of 5.5%.
Now, over onto the corporate calendar, we've got a pretty quiet week ahead with none of our star stocks reporting and no star income stocks going ex-dividend. However, Net Wealth is due to release their June quarter update on the 14th of July, while Rio Tinto is set to deliver its second quarter operational update on the 15th of July. Over onto the technical alerts, and BHP and Perseus Mining turned bearish on the SD Max, while South 32 triggered an exit on the SD30 TSR.
In Under the Microscope this week, we run our eyes over failed debt collection company, Collection House. The company was one of Australia's biggest debt-chasing agencies and worked on behalf of companies like the Australian Tax Office, utility and credit card providers. It would buy the debt ledgers such as overdue credit card debt at a heavy discount of around 1 cent to 35 cents in the dollar and try to recoup those funds.
Up until 2020, its historical financial performance actually appeared quite strong, with decent return on equity and healthy earnings margin. However, its fortunes took a bit of a dive during COVID-19 when it lost $145 million. Marred with high levels of debt, the company tried to deleverage by selling off its assets. Some of its purchased debt ledgers were also purchased by its competitor Credit Corp. However, its attempts to recapitalize failed, and the company eventually went into administration earlier this month.
Yeah, and Lincoln's financial health ratio preempted the rise in insolvency risks as early as December 2019, when the combination of falling profitability and also high gearing saw its rating fall from strong to early warning. But a few investors may be wondering whether these issues will also impact borderline Star Growth Stock and Star Income Stock Credit Corp as well.
Yeah, and I think that's a pretty good question. On the whole, we feel the failure of Collection House is due to its own undoing and does not reflect a structural change in the Australian debt collection market. The current BDL market remains stable, supported by low loan arrears and also high employment levels. Now, Collection House has engaged in the past in hardball debt collection tactics, which often involved costly legal proceedings, and this struck a negative chord with regulators and also consumer advocates. At one stage in 2019, the level of short interest reached 8%. And in addition, its CEO also left abruptly at the end of 2019 and sold down all his stock.
Yeah, a few company-specific risks there, Jace. But in contrast, the management team of competitor Credit Corp is more conservative. They prefer a customer-centric approach to debt collection rather than relying on heavy lawsuits. And this is why it continues to generate a return on equity of around 14% and net profit margins at 23% over the last few years. The company is better capitalized with lower levels of gearing and has a profitable US debt operation as well, which diversifies its core Australian business. Many stocks are trading at significant discounts to consensus valuation. And here at Lincoln, valuation is not a primary golden rule because it's highly subjective. So the key question this week is, why should investors be careful of relying on valuations in the current market environment? Now, firstly, you can find the consensus valuation or price target of a stock under Golden Rule 5. This figure is the median of the total analyst price targets that cover the stock. But these price targets are subjective and based on future assumptions, including cash flows and interest rates. It's difficult enough to predict cash flows for 1 year ahead, let alone 10 or 20 years into the future. And with increasing economic uncertainty and rising interest rates, the present value of the future earnings and cash flows can change very quickly.
Yeah, that's a good point as well. Another thing to remember is that when a stock is actually trading at a significant discount to valuation, especially if it is not a star stock, then it often implies that there are heightened risks attached to it, and this could lead to further earnings downgrades or share price declines. Now, this is also true for low quality income stocks that display a dividend yield that often looks too good to be true. This concept is referred to as a value or a yield trap.
Yes, and the reason why many stocks are trading at a discount to valuation is because the consensus analysts haven't really factored in the systematic risk to earnings, such as rising interest rates or inflationary cost pressures that could potentially lead to a decline in earnings expectations over the next few months. But these macroeconomic risks could represent opportunity across our star stocks. And investors can review the strategic comment and active risk section before making an investment. And if you're not comfortable with investing with these risks, it's always best to wait for the financial results in August to confirm your conviction in the opportunity.
Yeah, that's a good point as well, Kien. From our research, we found that the share price trend tends to be more useful when building conviction around stocks rather than just looking at the absolute discount or premium. Under Golden Rule 4, share price sentiment, you can track this consensus share price target with the share price, but note that the share price tends to lead consensus price changes and not vice versa. This means that if the share price falls significantly, then there's a good chance that the consensus share price target will follow. Hence the reason to treat valuation with a bit of grain of salt.
Yeah, and some parting words here, Jace. Benjamin Graham, the author of The Intelligent Investor, he observed that the greatest losses result not from buying high quality at a high price, but from buying low quality stocks at very cheap levels. That's all we have time for today. And thanks, Jace, for your contributions.
Thanks for having me, Kien. It's great.
And also, we have provided instructions on how to account for the BHP Woodside Energy merger and also the BHP in-specie dividend in your Stock Doctor portfolio. And you can find this in the Help Center. Also, a reminder for members to attend our Lincoln Live webinar on Monday, where our Chief Investment Officer, Tim Lincoln, Portfolio Manager, Matt Swartz, and Stock Doctor expert, Rob Manfrey, and of course, myself, discuss the market strategy and answer your questions on stocks. So to summarize, invest based on facts, not forecasts or opinions, and treat steep valuation discounts with caution. But for high quality star stocks, this could represent opportunity. Monitor the active risks of the business, and if unsure, wait until the company reports their financials in August before taking a position. Take care and have a happy, healthy, and prosperous week, everyone.